the banking issue is not over, and it's been muted, yes, for sure. But what this is, in essence, is a bunch of commercial real estate and residential real estate loans are going bad. Auto loans, they're all going bad. People aren't paying. They're running late. They're delinquent. No one's in office buildings. I was at my attorney's office in Minneapolis last week. They have 3 floors of an office building. Felt like I was in a morgue, literally. And they re-upped it like right at the beginning, right before the pandemic hit. They re-upped a 10-year lease. I mean, in downtown Minneapolis, you could have 10,000 people on these 3 floors, literally, and there's no one there. It's crazy. But this is the kind of problem, not my attorney's office, but many like it, where they're delinquent. They're not paying. They're going into forfeiture. And so you have a bunch of these loans that are going bad, which makes the banks run low on cash. They're not getting their payments. So to stay afloat, they go and they hit the repo market, where this is where banks trade assets, typically U.S. Treasuries, for quick overnight loans from the Fed. I'll give you my treasuries. You give me some money, and then I'll buy back the treasury the next day or next week or whatever. It's overnight, it's next day. Some are longer than overnight, but that's why it's called repo. It means repurchase. Here's my treasury. Give me some money so I can pay my debt. I'll give you back the treasury, or I'll buy back the treasury the next day. Great. The scary part about all of this is that now these banks are pawning off their risky mortgage-backed securities instead of the safe treasuries. That is the sign of stress. That is what should be disconcerting. This is why the Fed injected almost $9 billion and opened up a $490+ billion emergency facility. Shh, don't tell anyone. No one knows about it. It's a $500 billion. And you don't do that unless something is beginning to fracture underneath the seams. And this is what we said would happen. And that's the part, that's why I'm so fond of the little by little, the logarithmic decay, because the little by little, these things that have been breaking little by little under the seams, instant gratification, even in information and in thought process, isn't quick enough for most people in this country. They aren't able to understand that these things take time. At this level, it is an ocean liner trying to turn. These are very big deals, and they're not getting fixed organically. And the problems with commercial real estate are only going to get worse, as are the problems with residential real estate. The only way the residential real estate problem gets better are for prices to go down and or for interest rates to go higher, not lower. That's what got us in this problem to begin with. Well, the commercial real estate is a whole nother animal altogether. You got all of these companies that realize, well, we're just as productive working away from the office as we are in the office. So why spend all the money? And it's creating a real problem. The banks are not out of the weeds yet. And when you see the Fed coming in and quietly doing this without, again, our media just is pathetic. Our media, guys like John Rubino, God bless them, guys like you, all the people who are telling the truth and getting the real information out. These are the ones that were shadow banned during the previous administration for misinformation that turned out to be true. But here again, where is the journalistic integrity? Where are the news media outlets talking about what is exactly happening? And what it means is the banks are in trouble. And not only that, no one wants to leave their money in the bank. They'd rather move it to treasuries, which short-term treasuries with disintermediating the bank, or even into money markets away from the regional banks and into the bigger banks. The problems are not done yet. And this is a good sign of it. When they are trading their mortgage-backed securities instead of their treasuries, they're in need for cash, and cash quick, and they're in trouble. It's kind of like, you're pawning off your wedding ring at this point, and hopefully you'll lend it to the pawn shop. Hopefully you'll buy it back, because your other assets are already gone. And it's a very scary sign, to be honest with you. Dunnigan, sometimes you'll get the comments in the YouTube sections. They'll say things like, well, they've been saying this for years. That's our curse. We're early, and we see things based upon mathematics, logic, and economics. That's Mother Nature, in essence. That's the law of mathematics, the law of economics. Some of these things are not really law, but math you can't run from. And these things always manifest themselves somehow, some way, usually way later than we ever think. But these are the things that we have been saying for a long time, and guys like Alistair who have been saying, and the Western elite have had a very, very magnificent ability to keep the ball up in the air through all sorts of gimmicks and tricks, accounting tricks, injections of money, lying about the measurements of inflation and employment and on and on and on, right? But at some point, Mother Nature says, well, you know what, your time is up. And at one of these moments when we least expect it, you will see a problem with a major bank. The systemic nature of it. We could look at the problems at the LBMA as an example. All we keep doing is focusing on the LBMA and what happens if there is a silver failure to deliver by one of these massive banks. These are all commercial banks. Well, if a bank fails in silver, fails to deliver, the systemic reaction, the contagion would spiral through everything, because they're not just bullion banks. They're banks that have their fingers in all of the other financial pies. The same thing is true here, and that you see one of these banks and you start to see problems with commercial loans. Not only that, you have what's called credit default swaps, where in essence, you're buying insurance against this stuff. And this is why AIG had to get bailed out. If it gets bad enough and you start to see big banks fail because of, bankruptcies, which are non-recourse in commercial real estate, and you just see this cascading effect. Now, we haven't seen it yet, but logic would dictate that we might, right? Who's going back to the office? And it's the opposite of that. Who knows where this leads? And this is when you see people start to pull out of regional banks, and the regional banks are the ones in big trouble, in my opinion, because of this exposure. So yeah, I think that this is why you see assets like gold and silver and cryptocurrencies like Bitcoin being purchased, because people are trying to get away from the potential for a systemic contagion that's out there. And this is a good example of how it could happen. And if the Fed wasn't concerned about it, well, they'd be a little bit more open about it. The fact that they're so hush-hush reminds me of the FDIC saying, well, if the public really knew, they'd freak out. Remember, we showed that video a year or two ago. It's the same thing, and it's just more of the same thing. That's why people like you, I always say it, are more of a real source of information and news than the media, which is more about divisiveness and entertainment, if you want to call it that. It's not about understanding what's really happening. And John, Rubino, and Alistair, they're spot on. This is a problem that has not yet resolved itself, not even close. The largest silver refinery in India evidently has run out of stock for the first time in history. India being one of the largest buyers of physical silver. That's a big deal. I think worth certainly mentioning. The managed money is short by over $1 billion on silver, meaning the commercial banks took the other side. I wonder how that's going to play out. I would suspect you'll see silver really start to move this week when the managed money, the dumb money, in relation to the commercial banks, the ones that seem to always be on the right side of the trade until one day they're not. And maybe this is the one day one would expect silver to really start to move higher here right now. I don't like to make those kind of predictions, but I will tell you that this is very unusual to see how short the managed money is. At the same time, you have, right now that the LBMA is blowing up in terms of running out of stock, you have, for the 18th day in a row, backwardation between spot and futures. Right now, it's about $1.24. This tells you that the people are paying extra to get real silver now, not in the future. This is not bearish. This is a panic for the real metal. At the same time, short sellers are now paying a 19% annualized rate just to borrow SLV shares, where we see a lot of shorting, and a 39% lease rate on the LBMA. This is not indicative of a well-functioning market. Bank of America on Monday raised its forecast of silver to 65 per ounce by next year, with an average of 56 and a quarter. Until then, they also lifted their outlook to gold for 5,000. And the last thing that I will say is, and I may have repeated this last week, but for people who haven't heard this, you got 4 or 5 things that are incredibly bullish. You got, as we mentioned before, Morgan Stanley saying no more 60-40, 60-20-20. Get rid of half your bonds, buy gold with the other half. 60% stock, 20 bond, 20 gold. When have you ever heard a financial advisor say 20% in gold? This is from their chief investment officer, their CIO. This guy and the people that I'm about to mention speak to not the plebes, but to the institutional level traders, not to the rest of us. They're saying put 20% of your money in gold and pare down your bond holdings by 20%. Michael Hartnett for Bank of America This is the one that just said, 60, whatever, $65 on silver. Michael Hartnett's newsletter, I don't know how much it is, but I bet it's 10 grand a year. He just came out and said, no, it's 25, 25, 25, 25. 25% stock, 25% bond, 25% short-term treasury, and 25% gold. Whoa. Then you get Jefferies. Now, as you mentioned at the onset of this meeting, we were blessed by Prudential Beige about 20 years ago, and they nominated us. The authorized resellers, the 6 or 7 of them, can nominate one primary reseller, the primary distributors can authorize one authorized reseller. And they did. Prudential Beige authorized us or nominated us to be an authorized reseller, one of 27, about 2 decades ago. God bless them for that. Walter Pahowicz, if he's still out there, Walter, I love you. He used to run their desk. They got bought by Jefferies. And Jefferies Beige was the name. Jefferies Beige was a primary distributor for all the major mints. They understand gold. They subsequently got out of the market, sold off the Beige name, and it's just Jefferies. Their head trader is saying $6,600 gold is their next stop. They understand gold. But maybe the biggest of them all is Jeffrey Gundlach, the bond king, the man who's made his mark, his fortune, and his moniker of being the bond king by selling bonds, who just came out and said a 25% portfolio allocation to gold is not overweight. Really? So when you see these people at these levels, and then put into it all the stuff coming into COMEX and the draining on the LBMA and the high lease rates and all of this stuff, the Judy Sheltons of the world, and the Trump saying he who has the gold makes the rules, and Bessent saying, I want to remonetize, be part of a new monetary. Keep going. I'll keep going. And I'm telling you, and I hate to say it, I cringe saying it, but this time it's different. And look at gold. Got the snot kicked out of it by over $100 last week on Friday. And what are we at today? We're up $108 right now as we speak. The physical demand is different than I have ever seen, as are all of these things. People at that level speaking to institutional traders at that level saying 25% allocation is good. Never seen that before, man. Not even close.